Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. All right, Charles, thanks so much for taking the time today just to go through, I guess, the flip side or the other side of the same coin when it comes to investing. We talked about in a previous call, we talked about the buy side and sort of what sort of goes into, finding a right company on the, to buy in the first place, which is obviously one part of the equation of investing. But the more, also an equally important part of the equation is the flip side of that, which is the time to sell. There's got to be something that says, okay, now is the time to take what we've currently realize or have as unrealized profit and actually realize it. And there's got to be some sort of a discipline behind what goes into that. And I'm sure, the discipline sort of starts off with a lot of science and the metrics that go behind the science of it. But then there's an art that goes into it as well. And I know in our previous conversations, that's become very, very apparent to me. So I thought maybe you could just go through an example of a sell side, what it was that encouraged you to say, you know what, now's the time to take our money off the table with this particular position and redeploy it into something else, and it's for these reasons. So I thought I'd let you take over with that and just give us a bit of an overview on one of the sell side.
Good. Just as a little bit of a background, when the process is obviously the most important thing. So most of the work goes into a buy side. So the idea is if you're going to buy a business that you really like and it has all the attributes and all the things that you like, you're going to buy it at the right price. And hopefully down the road, you're never going to sell it. That's not usually the case. And we've heard a lot about buy and hold is dead and it doesn't work anymore. But buy and hold always works if you understand what you're buying and you buy it at a good price, and then you're going to sell it. If you're forced to sell it, there could be a few reasons. One is that the reason you bought it is no longer valid. There's a particular change in the company. There's different drivers in the company. It might be acquisition oriented, or there's some change in the business model that no longer equates to the reason that you wanted to buy it.
Okay.
But for the most part, if you do a lot of good work up front, you're going to be selling and buying because of evaluation. So buy and hold, yes, you don't want to just buy it and then forget about it. What we're looking for is overvalued and undervalued situations, and if it becomes overvalued enough, what we're interested in doing is selling it until it gets back to the point that we feel it's attractive again. And a good example of that is a company called Praxair. And Praxair is a really sort of good to great business in the U.S. It engages in the production and distribution and sale of atmospheric and processed gases, surface coatings in North America and Europe. They're all over the world. They sell all kinds of gases, oxygen and nitrogen and argon and rare gases and carbon dioxide and helium. It's a really fabulous, basically predictable business.
Okay, great.
And this company's been absolutely wonderful. So I bought it in December of '08, and I paid $59.45 for it. Because when we're looking at it, it was undervalued, and the process that we started with before about why we buy the business which is we buy it. Now we're looking at the flip side of why we're selling it. So what I did is in January 2012, I sold the company at $109, and then basically a year later, the stock is trading at $112. So what had happened in the business and what had happened with the company that led it to a sale? One of the problems, or one of the areas of concern with Praxair and with a lot of other businesses, is they grow their business, they grow organic earnings, they're really operating on a free cash flow basis, and then what they do is they start to grow by acquisition. So they're not growing fast enough, or they want to grow faster. What they do is they start buying other businesses, and we see this in all areas of corporate America. But what happens is, what are the quality of the business that they're buying? So they're taking their cash flow and they're buying other businesses, and then they're bringing those businesses through acquisition, and they're part of Praxair. But what happened with Praxair, it happens with a lot of companies that try and grow through acquisition, is growing through acquisition is fine as long as the company that you're buying has a acceptable return on cash. Don't forget, we're looking for the profitability of the businesses that we're buying. So if we're a good business and we make lots of money and good operating profits, and we buy another business, well, we want to buy another business that's as good as our business. But more often than not, because of all kinds of reasons and emotional reasons, acquisitions don't work. And in Praxair's case, they started growing through acquisition, and what happened is they started buying a lot of businesses that their growth in earnings and growth in cash flow was well below what they anticipated. And what happened is they started buying more and more. For example, their last acquisition of company was $1.1 billion. And we look at what the expected return was on, so we take the $1 billion out of Praxair, we buy the business, we bring it into Praxair, and it's been very disappointing.
So in essence, is it like that every time they bought a business, they were sort of adding a bit of a bucket behind their boat, and it was kind of slowing their progress down?
Yes.
Yeah, okay.
Now, we all understand and we all know that for the most part, acquisitions don't make a lot of sense. And certainly in technology, they don't make any sense. So what we're just trying to do is I'm saying, okay, Praxair, you're a good business, you're buying, and you're growing through acquisition. So I say that's fine. But what happens is we're starting to see the earnings come down, and we're starting to see the return on invested capital come down. That's diluting the company, and that's making the company less valuable. All at the same time is that the stock price is making new highs.
And is that because the market just isn't seeing the fact that the acquisition, or that the growth in the company is being fueled by the acquisition, and the acquisitions just aren't as good as the company was itself?
That's exactly it. But most people aren't looking; they're not doing a deep dive on what the rate of capital return, invested capital, is on the new acquisitions.
Right. Okay.
So what they do, and you can see in research reports, they say it's a best-of-breed company. We like it. Things are really great, and over the long term, Praxair is going to be really great. Those are the research reports out there to the public, or out there in my industry, done by major companies. But when you actually do the deep dive and you go through it, you're saying, oh man, these guys got a lot of problems. So the lot of problems is that what they're reporting in earnings per share and what they're actually making in earnings per share is creating a false positive. In other words, when we go through the actual process, they're not making those kind of earnings. So the company's becoming more and more overvalued in terms of its operational value, and is now, the overall rating is a dangerous company. It's way too high for their operational value.
Right, okay.
So something's going to have to happen. Either their earnings are going to turn around and it's going to be really good, or the stock price has got to come down to meet what the valuations are. And in this particular case, it has not fallen yet, but it will fall, because it's, to give you an example, you know, if we owned Praxair, over the last 5 years, the revenue, over the 5-year period, the revenue has grown by 1%. Over a 3-year period, it's grown by 5.3%, and over last year, it's grown by -2%. And we're also looking at the earnings margin. So the earnings margin in 5 years is 3.5%. And the last year it was 3.9%. So to give you an example of what the value is, at the market price of $111 or $112 now, the revenue, the annual growth in revenue it's got to basically double or triple over the last 5 years for another 11 years in a row before it's going to get to the point that the valuation is equal to $112.
Wow, yeah.
In other words, the expectation is very high. Now, on the economic earnings, it's 3.5% over the last 3 and 5 years, and then 3.9 over the last fiscal year. But we're going to have to see those margins grow by 4.5% over 11 years. In other words, the expectation is very high over the next 11 years. It's got to double to meet the price that it's trading at now.
Interesting, right.
So this becomes more apparent and more important is if you're an actual owner of the business.
Sure, yeah, because if you know, in the experience that you had when you bought it originally was here was a great company, it was growing organically, and you know, you recognize that the market, I'm assuming the market hadn't recognized the future. What was it? I guess the question is, what was it that attracted you to it initially?
Initially, all the things that I'm talking about now were reversed.
Right.
So
okay.
Everything was reversed. So what the market, when I bought it in 2008, see, the stock actually got down October 2008. It got down to, around $45 or so.
Right, right.
But that was also the point when everything was down. And as we've said before, when you're looking at it, what's the valuation? So in 2008, the market price was saying that Praxair will never grow again as a company.
Yeah. Yeah.
Remember, just go back to what we did. We flipped before when we talked about the buy side.
Right.
So we go back to 2008 and listen to the buy side again. Go back to 2008, and this was fantastic. Here's a perfect example. Now we get to 2012, 2013. Now it's the opposite. The market is saying, well, you guys are so great. You're gonna grow faster and longer than you ever have in the history in the midst of making not great acquisitions and spending a lot of money. So your earnings are dropping.
Right.
Your free cash flow is dropping. Your valuation is going higher.
Yeah, no, that makes a lot of sense. So basically you've got a situation where in 2008, and if we, take ourselves back to 2008, that was probably the most challenging year we've ever seen in our investing and our clients' investing horizon or her investing history that they've ever seen. It was the most challenging time. It was one of the largest market drops in history. Yet at that point, it was probably the time of greatest opportunity as an investor.
This is the most important aspect of investing. It's not buy and hold forever. What it is, you never time the market, but what you do is you time the price of good companies on the buy side and the sell side.
Right.
So when a good company, we time the price. If the price gets low enough, we love it. If the price gets so high that we're working to get the expectations are way too high for the company to be able to meet that expectation, then what we do is we sell the company. We don't sell the market, we sell the timing of the business because the business is very overvalued. But here's the flip point. When we should have bought it, and you could have bought it with the most value, is the emotional distress. And then when you should be selling it now and people are buying it now because they've looked over the last 5 years and it's been a great company and the stock price is going up and everything looks really fantastic, what they're doing is because they can see what's happened, they are justifying their emotional aspect of wanting to make money because they've already seen it go up for 4 or 5 years, which is the exact opposite of the buy. So when you feel most comfortable, when you see something that's gone up for 4 or 5 years, that you say, okay, must be a great company because it's going up, is the exact time to sell it, but you don't do it because you do not have the skill set to be able to understand what the actual valuations are. So there are a lot of research. There's lots of research people out there in North America that are putting buys out on Praxair.
Right. And it just, when you've done the deep dive on it, you're saying, okay, this doesn't make any sense. You've got a company that has growth that the market is seeing as this darling of a company because of its history. But when we take a look at the company today, it doesn't represent the company of the past. It's a different company that's on a different path.
What it is, it's a different price. It's not a different company, it's a different price. Now, if it goes from 112 and say it went back to $60, then all of a sudden we would love this company.
Right.
So it's really a case of price. Now, what they do is they're making acquisitions at a higher price. If they made acquisitions at a lower price, or if a company bought a company and said it was worth $1 billion, and then the stock price dropped by 50%, well, then that we're not paying $1 billion for that acquisition. We're paying less than half of that acquisition. So yes, you're right. That's why we time what market expectations are in terms of valuation. At a certain price, Praxair, we're going to buy it again. I just would love to see the thing collapse, and then we would be back buying again, because you can see the difference of the price in the buy and the sell in terms of valuation. Now,
yeah, it makes total sense.
Yeah, so at any point, if the stock drops far enough, we will buy it again. The same as Nike. If the stock drops far enough, we'll buy it again because it's a wonderful company. But here's the rub. The rub is this. Only buy companies that we understand that have predictable cash flows, and we can take most of the risk out of buying it, because the ability for us of the companies to be predictable and be number one or number two in their field. We don't want to buy and then sell companies that are all over the map or totally unpredictable.
Right.
So, for example, if we sold BlackBerry, why would you buy? Some people might buy BlackBerry back at $7 or $8 or $9, but because it's an unpredictable business we don't understand, we would never be involved with that business anyway. So what we're doing is we're just buying really great businesses, and we're waiting for the public to display their emotions in a way that benefit us.
Right. Yeah, and that's the classic capitalism and taking advantage of the opportunity when it presents itself, but you can only recognize the opportunity when you know the numbers. And that's where that's where science and art come together. And you've got the metrics behind the science, and then the art is the wisdom and experience of understanding and knowing when the right time is to do the right thing. And it's the right time to do the right thing from an investment standpoint.
Can you name me any successful situation where fundamentals don't matter? If you're learning how to ski, if you're learning how to play golf, if you're learning how to fly a jet, we all start from the fundamentals, and the fundamentals are so important. And in my business, because emotion gets so caught up in it, which astounds people from time to time on why they would do that. So what we're doing is we're taking advantage of the mispricing in the marketplace by the most individuals. So what we're doing here is at $112 Praxair, you're making a bet. So if I'm going to buy Praxair at 112, I don't have a lot of odds on my side that I'm going to win here. I'm going to lose. It's like betting that Tiger's going to win 3 out of the 5 next majors. Well, from a probability factor, you can't win. So what we do is we gave it to them a little early at 109, but it's at 112. But that doesn't matter. We booked a wonderful profit, and it's still a wonderful company. We just like it to come back to us again. You can see the fact that when people are the most upset is when we go on a shopping trip.
Yeah.
But it's very hard to understand that, isn't it?
Well, it's interesting. That's one concept that people understand, when they're going to buy shoes, or when they're going to buy, something that they've been researching for a while. And then all of a sudden, if somebody came along and said, hey, this car or this, whatever it is you were looking to buy, the price of it, you've been researching, you love the car, everything's great. Or even, you could even use a house for that matter. People know it, they love it, it's great, and they've been watching it for a while, and then all of a sudden, if somebody came to them and said, hey, listen, that house is now 50% off, you would be ecstatic. Or if that car is all of a sudden for this day or for these couple days, it's now 50% off. Great, you jump all over it. But as soon as that happens in a stock, as soon as that happens in a company like Praxair or whatever, people say, well, what's wrong with it? Why is it down so much? What do other people know that I don't? And then it stops them from making the right decision.
But what's left out of that is the skill set to have the fundamentals of understanding what you're actually doing. Once you have the skill set, then you understand. We use our our skill set to you and the expectation of the marketplace for us to make profits with very low probability risk.
Yeah, margin of safety.
Margin of safety. Now, that doesn't sound all that difficult, but when you understand the fundamentals, then the emotion doesn't take over. We use the emotion as an advantage.
Yeah, that's great. Well, listen, Charles, thanks so much. I mean, it's a nice overview, basically, of probably a 15 to 30,000 foot view, because there's obviously a lot more that goes into all these decisions. But from a conceptual standpoint, I think it paints a nice picture for both sides of the equation. We talked briefly in a previous call, and briefly today we talked about the buy side. But then just as important is the sell side, and when it's right to sell, and when you actually sell. And I think you've touched on some key indicators that you pay attention to, and then you justify it with the science, and then the art says, okay, you know what, it doesn't make sense. It's not a good decision to hold it any longer, and everything sort of speaks to you and says, okay, it's time to sell, and you sell. Not saying it's a bad company because you're selling it. You're saying that it's time to sell because it doesn't make sense from an investment standpoint. Yeah, it's overvalued. That's great. Well, listen, thanks so much, Charles. It was, as I say, it was a great overview. Love hearing sort of the discipline that goes into to both the buy and the sell side. And I look forward to sort of talking more about some of the new acquisitions and the new dispositions that will take place as time goes on. So I really appreciate you taking the time and going through all this with me today.
Great. Thanks, Scott.
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment, and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.